Hi friends, Lee Brinkey here, and today we're talking about how important it is to have a good credit score when getting a mortgage. Now, everyone knows you need good credit to get a mortgage, but how good of credit do you need depending on the mortgage you're getting? And we're talking about that today with our good friend Brent Stars from Unitas Lending. He's going to tell us everything we need to know about credit scores, how good of a credit score you need depending on the mortgage you're getting, and then also how you can actually repair your credit or improve your credit score very quickly by using the right lender. So don't go anywhere. So hey Brent, how you doing today, man? I think so. Hi Brent, how you doing today, buddy? Thanks for joining me today.
Doing greatly. How are you?
I'm doing all right, man.
Good.
So tell us why a good credit score is really important when getting a mortgage.
There are several things. Yes, you brought up a point in the intro there. There's, it can mean getting a mortgage or not getting a mortgage, actually. So it's super important. And it's basically every 20 points. The FICO score goes up to 850, but every 20 points, if you're at a 560, you can get a FHA mortgage. The rate's going to be higher. You have to put 10% down. And then every 20 points it improves. Actually, we've gotten FHA loans approved down to a 500 score, actually, but the rates are quite high. But every 20 points you improve your score, your rate improves, the terms improve. So it's 580, 600, 620, 640. And your point earlier, the FHA program that we have, FHA, that's 640, you're getting the best rates. And so it's a very good program for those with a little lower score. And then every 20 points it improves, other programs open up, but you get to a 720, 740 for most lenders. That's when you're getting a premium interest rate and terms, anything above 740.
Tell us what the rate actually impacts as far as closing cost and down payment.
Great question. Yeah, FHA actually rates are actually lower for FHA mortgages. And people say, well, why wouldn't we all get an FHA loan? You have to look at what's best for you. The FHA program is it's great for first-time home buyers. You don't have to be a first-time home buyer, but if you have a score at 640 or below, it makes all actually 620 or below. It makes all the difference because you need a 620 score to do a conventional loan. So it's a difference between having a loan or not. It's just Fannie Freddie guidelines. The government-sponsored enterprises that back those loans or purchase those loans. So it's either you make it or you don't, but right. The closing costs are, in an FHA mortgage, you can get a 6% seller credit right now or builder credit towards closing costs. FHA is very lenient as far as credit. You can actually make less money. So your DTI, your debt to income ratio, can be higher. In other words, it's easier to qualify on your income. And the rates are better. The reason FHA loans are less, the interest rates are less, is it comes with federally backed insurance. So that insurance is an additional cost every month. And that cost is flat on FHA. So in other words, your mortgage insurance is 1.75% of the loan amount and 0.55% of the loan amount percent over a year. So divided by 12. So it's a little more expensive typically. And so so we have to just weigh what's best. Conventional over 620, you're in that range and you can get a conventional loan. And if you put 20% down, you have no mortgage insurance. But it impacts the cost of the mortgage insurance on conventional. So they look at two things. They're looking at the LTV on a conventional loan, the mortgage insurance, and the credit score, and it can make a difference. Lee, I've seen a couple.
And that LTV is the loan to value. Explain that real quick, because
okay, let's use round. Yeah, good question. So let's use a round figure. Let's say you're purchasing a $100,000 home. There's not many of those, but let's say use $100,000. You have to put 20% down to get an 80% loan to value, an 80 LTV or loan to value. And so anything, 20% down or more, there's no mortgage insurance for conventional. However, FHA, if you have to go with an FHA program and you put more and more down to qualify, you have an FHA mortgage insurance regardless. So that's why it's really important to talk to a mortgage professional to see what's best for you, because the differences can be tens of thousands of dollars, certainly across the life of the loan. It can make an enormous difference.
Right. And when you bring up that point of talking to the right person, someone might walk into a bank and the bank turns them down and they have a good credit score and they have good income, but they use what's called overlays, and that could kick the person out. Explain the difference in a direct lender or a bank that's using overlays and a mortgage broker like yourself who's not.
Yes, absolutely. Credit unions and banks, they don't want to foreclose on anyone. So they require higher credit scores. And those are credit overlays. In other words, the loan is possible. Fannie Mae, Freddie Mac, they will purchase the loan. However, the bank does not want to lend on that specific transaction with that specific FICO score, because they don't want to be in a position where they have to foreclose. It's not good PR. And so, and it's a non-profitable thing too. It's a very expensive thing to foreclose on a property as well. But we have zero overlays. And so if Fannie Freddie will accept it on the computerized program, it's called DU and LP. Those programs we run, if we get an approval, then we can move forward with a loan. And not only that, I've actually had people get turned down by a bank. They come in and they've got a 665 score, and the irony of that is they're turned down for an FHA loan. And with a 640 score, 25% lower, we can actually offer the very best rates we have. So it can make a big difference as far as who you're looking at as far as a loan. We shop all lenders. And so if it's available out there, we have access to it.
Right. And that's the thing. You have multiple lenders you're using depending on the person coming to the table. I mean, you might have someone coming to the table with a lot of money, but they live off a balance sheet. And so they don't really want to they don't show income. And so that's a loan that you can do. You can do a loan. You can do VA loans. You can do FHA loans. You can do conventional loans. And you have different lenders depending on the credit score and also on the situation that the borrower might be in. So it's always good, I think, for people, if you're out there and you're looking to get a loan, is to talk to a good mortgage broker like Brent, which he's always available to talk to, because especially if you've gotten a quote from one bank or lender, because even with these new construction right now, the incentives are pretty high on most properties, but in some properties there's no incentives depending on which builder it is. And, sometimes a $5,000 or $7,000, $10,000 incentive on closing costs really isn't worth it. When you go over to Brent and he shops that mortgage for you and finds you a much better rate with a much better terms, correct?
That's exactly right. We're closing a $2.8 million loan this week that was turned down everywhere. And it was quite easy for us to do. A self-employed borrower, what you mentioned earlier, a profit and loss loan, showing that the business makes a profit, adding back at depreciation and all those, the crunching of numbers that gets it to a sense where it's a make sense loan for the bank. And so then there's an investor out there to pick that up. And so, yeah, it's the perfect scenario for us. We do a lot of builder turndowns, frankly. So
right, exactly. Mm-hmm. Yeah, builders are pretty strict because they're direct lenders and they're staying in that one kind of pathway, and they really can't get out of the box to help someone. So that's when the loan comes to you. So tell us the key components. What are the components of a good credit score?
Yeah, the first and by far the most important, it's 35% of your credit score. This used to be a big mystery, right? That, how do they, what's the algorithm? And it used to be a more objective view. Now it's an algorithm because there's so many credit reports and there's so much information that's available and that's able to be calculated as far as estimating risk. That's the whole idea of the Fair Isaac, company, the Fair Isaac score or FICO score. The very first and most important is the payment history. That's 35%. So how you've paid the most recent debt is the most important. So give me an example. If you've had perfect credit your whole life, you've never missed a bill, and you suddenly miss a payment. Let's say you have an 800 FICO score, you miss a 30 days late on a credit card. Your score is going to go down drastically because the computer's reading, hey, you never miss. And this is the early stages of a medical situation, a job loss. The computer knows that because, there's millions and tens of millions, hundreds of millions of people, and they have the credit information. So believe it or not, there's someone that looks just like Lee Lee Brickey on as far as a credit profile. And there's someone that looks just like Brent Stars, right? That has, 5 credit cards, a home loan and 2 auto loans, that type of thing, and has credit for 30 years. That type of borrower, and if that borrower was never missed, they know that's a beginning of a problem. Someone that's never, that's always late, and they have a 30-day late on an additional credit card, but they're 60 to 90 days late on their credit cards all the time. Their score won't be impacted much at all. It's already low because of that history, right? But it's not like, it's looking for something new. And the flip side is that, so someone that's down 1 month, hey, if it's paid back and brought up to speed, or it's eliminated, or we can get on the phone and have them remove the late because, hey, there's some type of reason and that was justified, a tornado hit your home or something like that, that things obviously were out of order. And so, and you're back on track, then they will a lot of times remove that. So a lot of times we can get things removed, and that with a deletion letter, and that's the most important way to improve your credit score, get duplicates off your credit report. Sometimes things are reported twice. So payment history is obviously the most important, and it's most current. So it seasons awfully. So let's say you have a judgment that was paid off 2 years ago. That has less impact than something that happened recently. Again, the computer algorithm is looking for, is someone just going into trouble? What's the likelihood of this borrower becoming 90 days late in the next year? That's what the algorithm is looking for. And with millions of credit reports to garner data from, they can estimate that very accurately.
Right. And then length of credit is important too, right?
Yeah, it is. Absolutely. So the length of credit, obviously that's just done with time, right? And so there's nothing you can do really, other than there's one little trick. Actually, I've seen where people put their kids on their credit cards as authorized users, and it drags all those years of good credit over. So I actually have, a couple of my kids have credit cards that are older than
I've
they are.
done that with my daughter, and so she's got really excellent credit. Her credit's actually better than mine.
Right. So you be careful about which ones you authorize, right?
Right. And then this is something you really have taught most people, is credit utilization. Like now, people have a ton of credit. A lot of folks have right now a lot of credit card debt, and we're seeing that in the market when we're doing these loans. And so that's another thing. Talk about that real quick, because that's something that they could get additional credit cards. They could call in and get get their balance of their credit card balance raised, so that reduces the amount. Talk about that a little bit.
Oh, absolutely. That's the number 2 impact as far as the category that impacts credit scores, is the utilization percentage. So the computer's looking for 30% utilization or less, and I'll explain what that is. Let's say you have a $10,000 credit line. And if you have it at $3,000 or 30% of $10,000, at $3,000 or less on a balance, the computer is going to say, hey, there's no trouble here. If you go over 30% and you're at $3,500, and you're 35%, the computer's saying, hey, you know what? It's kind of going up. I'm not really comfortable with this. You get to 50, 75%, and 90 as a real critical marker. The computer is screaming, you're going broke, you're going broke.
Right.
You have no more access to capital.
Because it's just an algorithm.
It's an algorithm.
It's a route algorithm. It's just
reading.
It's not a person looking at your credit.
Exactly right. And it's not looking at the loan or credit amount. It's looking only at the percentage. I'll give you an example. I had a woman, we had to run her credit, 2 weeks before closing, and her score dropped 40 points. And she had a very thin credit profile. She had a car loan and I had 2 lines of credit, like a Target was one of the credit cards. And so very thin credit. So anything that changes a lot, it impacts it more. That makes sense, right? Because they're looking at the whole picture. And so if she's late on one credit card, 1/3 of her debt is delinquent. Does that make sense?
Yes.
Yeah. So she had a $400 line of credit, right? And she had, when I pulled her credit to close the loan, we had to rerun it because it had been over 90 days. We pulled it and her score dropped 40 points. She no longer qualified for the mortgage. So I said, what is going on here? She goes, well, I pay it on time. And what the problem was, she had it charged to $395. So the computer is saying, hey, you know what? She's at the end of her rope. She's going broke. And the irony is she paid her credit card off every month,
Right.
and said, she goes, I said, well, I can pay it off. I said, I really don't want you paying it off. Can you do me a favor and ask, for a $10,000 line of credit? And she goes, well, I only have 400. I said, ask for a ton and see what they give you. They gave her 2,000. So,
Right.
so we were able to get that percentage way down to below 30%. The score popped up to 40 points. We just ran it, literally within 3 days, and we had her score back up, approved it, and closed the loan. So that's an example of, utilization, and it looks at the whole utilization. So you want to keep all your cards, ideally, below 30% utilization. Then there's a couple tricks to the trade too. The computer loves 7 to 10% utilization, loves it, because you are what the lender wants. Someone that's, paying their credit cards and still borrowing money, because what do lenders want? They want to lend money. And they also
Right.
want, but they want to keep that balance under control, right? So that the computer gives you a little bonus in that short category. Another one is to pay everything down and leave a $10 balance. That's another one, little trick to the trade. And sometimes that'll maximize and pop the score up a little bit too, because hey, I keep debt, I keep it paid on time, but I always keep that really low. But for some reason, I found that 7 to 10% is kind of a sweet spot. The computer just loves it.
And then new credit inquiries. This is a big one because people are, I know that I do this, and you give me a hard time sometimes about it, but but we just
Right.
got universal passes, right? And so
Right.
they were offering $200 on their credit card, and then you get a 10% discount in the park, I think, and there's some other little benefits to it. But so I get the credit card because it's like the passes were over $1,000, and if you put $1,000 in the first 3 months, you get the $200. So I play that game with it. But every time I do that, I watch my credit score drop, and it pops back up the following month because they're doing a hard credit. But some of these, people go places, and that's a real important thing, because I know that you run a soft credit
Right.
pool on someone who's just getting started,
Right.
looking at a mortgage. Builders do the same thing, and then you can go into like a store, and they'll do a soft credit pool or something if they're offering a special with their credit card or whatever.
Right.
But I think that's something that folks really need to understand, is that you want to keep those credit inquiries down, because they will lower your score.
Absolutely. And I'll tell you why. When someone's applying for credit and applying, and there's not a lot of new accounts being started, they're initiated, that's the computer reads that, hey, they're being turned down by the lender, and that's bad.
Right.
That's bad. The other thing is when someone's applying and building up, I've seen people with $400,000, $500,000 total access to credit. That's somebody that could be also very dangerous, right, to a lender,
Right.
because hey, I want to pay $400,000 cash and do cash advances on credit cards. I've actually seen things like that, and so
Right.
that's considered risky behavior as well. So the computer doesn't like that. One thing that they've done, it used to be, I was saying earlier, it's kind of an objective scoring system where, if you ran your credit report, it'd go down 3 points. The second time you run it, it goes down 5. That's the way it used to be. Now they bracket them, Lee. So if you are shopping for an auto loan, they're kind of leaving a 2-week window open, where if it's an auto, by the way, there's different types of credit reports. A mortgage report is different than a consumer credit report, which is different than an auto
Right.
credit report, right? They're different models.
Right.
And they're looking for different things. Obviously the mortgage is going to focus on larger installment loans, that type of thing. How do you pay those? And then specifically auto loans, look at auto loans. How have you paid other auto loans? And consumer credit looks at other.
Right. And that's your credit mix that you're
Yeah.
talking about right now.
Yeah.
Yeah.
Exactly.
Right.
And by the way, this is a pro tip as well. The computer loves 3 or 4 revolving lines of credit, which is or credit cards. They love major banks. They don't like the off lenders, the finance
Right.
companies, that type of thing. So if you're buying a piano or something like that, and it's a finance company, like Household in the old days, those types of lenders, Transamerica, they don't like those. They like the major banks, those types of credit cards. And then one installment loan, which is great, like a car loan, a large payment you've paid every month for a year or two, and a mortgage. That's the perfect mix, where I see the highest. I've seen thousands and thousands of credit reports. So that seems to be kind of the sweet spot and the sweet mix of credit, not going overboard in credit cards. But if you're responsible for years and you have 7 or 8, 10 credit cards, it won't hurt your score, because you've managed it. And that's where the length of credit kind of comes into play as well. It looks at your history for a long period of time.
Right. And people need to be careful right now with, I think the biggest thing that we see, especially on first time buyers or, folks that are, I mean, even up to like, we see this all the time with buyers doing $250,000 or more, buying these expensive cars. I'm a believer of, just because I'm in real estate, I have one nice car, right? And then the
Mm.
other car, we've talked about it. Having a car that, it's just your utility car, something that you drive
Yeah.
back and forth to work or whatever. And then, if you need, you want to go out with your friends or whatever, having a nice car, but keeping that payment down and not buying, just too many expensive cars, because especially right now with the way interest rates are and so forth, we're
Mhm.
seeing cars wreck people's credits. Like, their loan to value, they have too much credit, and so they can't buy as much house as they need to, and it kicks them out.
The average new car loan, this is something that I heard like a year ago, and I verified
Right.
it was like $720 a month is the
Well,
average new car.
I can tell you it is, because I have, on one side we have the Lincoln, but on the other side I have this Ford Fusion, and I got 0% interest right at the beginning of COVID. You remember that?
Yeah, right,
And I've got 70,000 miles on it, and I was looking to maybe get something different, so I started car shopping, and I mean, the cheapest thing I can buy, which is like what my daughter's driving, just a little sport utility, is one of the small little Ford sport utilities. It's not very
right,
fancy at all. I'm looking at 650 on that thing. I
right,
mean, it's like, and so I was just like, you know what? I'm going to keep driving this and wearing the wheels off of it and put a warranty on it, because I've taken care of it,
right.
and it's a good car, and it's pretty, and I think it's a great car. It's a hybrid too, so I save money on gas. So those are things. And folks, I'm going to tell you something personal here, because I want you to understand how important this is, and how good of a person Brent is, and how much he knows this. If you've watched any of my videos, you've seen me lose a lot of weight over the last 3.5, 4 years. I got very, very sick and went from 200, right around 220 pounds, all the way up to 340 pounds. On medication made me sick, and I couldn't get off of it. I've had a couple of heart surgeries. I had my kidney shut down. I've had a lot of issues, and I went through a really, really tough time, and our credit got really destroyed. We couldn't pay our credit cards. Well, it didn't work for a year and a half. We went through our savings. A lot of things happened, and my credit score, 3.5 years ago, was in the high fives. Now I'm sitting on a 700 credit score, and that's also, because I've worked myself out of that, and I've done it with Brent's help. And so in a 3-year period, I can now, I've tons of open credit. I can pretty much buy anything I want. And, we keep our credit cards paid off. We don't spend more than we can. And we keep a little account to the side. We're about to take a vacation, and that's our vacation account, and our vacation money, and our fund money. And if there's no money in that money market account, we're not going anywhere. And I just started living my life a different way. So
Mhm.
I can tell you that if I can do it, you can do it.
Mhm.
And this happens to a lot of people. We're seeing it happen to many of our friends, because we're getting older, where someone gets sick, and it
Yep.
destroys their credit, but they make it through that. And it's a process of putting it back together. And I know that feeling that you think that, hey, this is never going to get better, but it will. You just have to put your head down and just work through it. And it took me 3.5 years, but
Right.
you can do a lot in 3 years. So if you're looking to find out how to improve your credit, if you're looking to purchase a home and you have great credit, and you're going to a bank or direct lender, it's always good to just give a mortgage broker like Brent a call. So if you're anywhere in Florida watching this video, Brent can do your mortgage for you. You also have a couple other states that you work in too, right, Brent?
Right, right. Yeah, and we do the non-QM stuff in like 38 states right now for the investment properties, and then
Right.
we're licensed in Michigan as well for residential and Florida.
Okay,
Right.
great. So Brent's definitely a good source to reach out to, and I would do that. And I share that personal experience with you, because I know this is a really important topic when it comes to getting a mortgage. and really getting anything, because once your credit's good, then it kind of flips, Brent. And that's the funny thing is like I'm making money off my credit cards now because I use them for everything. So I got a few free plane tickets right now. I'm flying my kids out to Colorado for free. And so it's nice to build up these points when you're rolling this credit and you're not paying those high interest rates, and you're starting to get it together and chip it away. And if you have good credit and you're looking to try to pay some of that credit down, and you own a home, a good way to do that is a refi, and Brent can help you with that too. Not right now, but we should see rates start to go down. And there are times when rates will drop, like they did a few months ago, where you could have, if you were in a high mortgage, it's 6 or 7%, you could have refinanced and pay some of that debt down. So lots of ways of fixing your credit, lots of ways of doing getting a better loan, getting a better mortgage, and Brent can definitely help you with that stuff. So I really appreciate you, Brent.
I really appreciate you. Thank you so much for your transparency on that, because I think what you've done in the last 3.5 years is absolutely remarkable, physically, mentally, everything, because, it's an example of how, bad things can happen to very good people. And it's not to be ashamed of or anything like that. It just happens. And so hey, what do we do when that happens? And you're a great example of someone that just really did everything they could to turn the situation around. That's not easy. And so I've watched I had a front row seat, frankly, to the whole thing. And so admire you for turning that around actually and sharing your story now, because it will help a lot of people. And it's something that, hey, we just need to look at the facts. Where are we now and where can we be? Because, 3.5 years is coming for somebody else right now. 3.5 years to come, and they need that encouragement. So thank you so much for sharing.
Right. I think you can change anything in 3 years. It doesn't matter how old you are. I've really become a believer in that. There's a good book out there, the 6-Phase Meditation, and Vishen talks about, anything can change in 3 years. Looking for a career, looking for anything, you can change your life in 3 years. And I feel like I've proven that, because it just hasn't been the credit situation. It's also been family, friends. But it's when I tell you this, you got to have a coach, and whatever you're moving forward in, you've got to have a coach. And Brent has been my credit coach and helped me get that credit straightened up and told me what to do and what not to do. And I, before I make credit decisions, I always give him a call and say, hey, listen, I want to do this, I want to do that. And he's always like, hey, this is the path you need to take. And so I really appreciate that from you, Brent. And I hope that other people can take advantage of that and have that, you over there as a coach, helping them move forward with their credit so they can get in the home they want to. Or if they have great credit, like I said, showing them, what you can actually do for them. Because we have a client that runs a bank and a credit union, and you were able to just crush what he had to get for himself through his own bank. So
right.
Yeah, you know what I mean. So it was
remain nameless, but yeah, that's true.
Yeah, remain nameless, but he was able to really crush that. And so when you're doing deals like that, it's really special. So thanks for everything you do. I really appreciate it. Brent's information is in the information section below. Please reach out to him. There's nothing to lose, everything to gain if you're looking to buy a home. So again, Brent, thanks, and we'll see you in the next video, bro.
See you then.
So I hope you liked this video. If you did, give me a thumbs up. I really appreciate it. It lets me know we're making the right kind of content for you folks. Also, if you have any questions or comments, go ahead and leave those in the comment section below. We love to hear from you, and Brent and I will answer any of those questions or comments. And also feel free to reach out to us directly. My information is right there on the screen, and Brent's is down in the information section below. You can reach out to either one of us, and we'll help you and guide you in the right direction. Also, if you have not subscribed, go ahead and slap that subscribe button, ring that notification bell so you don't miss any of our real estate tips and tours. Because if you're looking for real estate anywhere in the Treasure Coast or Palm Beach County, I am here to help. Be kind to each other, and we'll see you in the next video.